Welcome back to the second hour of the Big Money Show. I'm Brian Brenberg, along with my splendid co-hosts, and with us for the hour, Bahnsen Group founder and managing partner, David Bahnsen. Welcome, sir. Good to see you.
Thank you.
David, I'm so glad we have you today because I'm dying to get your take on this. I'm dying to see what kind of conversation it sparks.
Yeah.
Monroe Doctrine, Donroe Doctrine. I know you're going to know the constitutional argument for this, the economic case. Lay it out for us.
Well, look, I love these things where I'm in favor of it, and I think that a lot of the MAGA base is probably not for different reasons. Okay. I believe that he's 100% right. The president is right that people do need to know what the Monroe Doctrine was. For nothing else, history is sort of important, but our hemispheric presence matters. I'm not one who ever abandoned the fact that we have a moral imperative that is America first, that is in America's strategic interest around the world. And what you said a moment ago is exactly right. The biggest advantage to this, of all the things people are talking about, I have no doubt Maduro's a terrible guy, and I have no doubt he's a narco-terrorist and all of that. My happiness in this is what it does to China. That disintermediating a Venezuelan-Chinese relationship is extremely important to America's hemispheric interests. That's the way they ought to be defending it, in my opinion.
So I would argue that in the back half of 2026, you're going to see, if oil prices hang here in these mid to high 50s, you're going to see it increase because U.S. production is much bigger than it ever was. They're going to keep cutting down on production. Permian rig counts are down 30% last year. New wells drilled are down 20%. This is an economic imbalance that won't last that long, hanging out here at 55 to 57.
Venezuela is also not in the top 20 of world producers. What they even could bring to supply with this improved infrastructure, that takes a long time for those oil services to get online for the U.S. producers. Now, what you see in markets today is the stock prices of the U.S. producers, your Chevrons, Exxons, Conocos. That's indicating that opportunity is there, and then particularly with the oil services, Schlumberger, Halliburton. However, the fact that the bond yields didn't respond is no surprise at all. This isn't an economic growth story. 10 years down 3 basis points today. I don't think that should have gone higher or lower meaningfully because of this. I think that this is more a domestic in Venezuela, a local incident that then for global economic impact is going to take a long time to play out in oil markets.
So let me, David, you're in favor of what happened in a boots on the ground scenario. Okay, let's go back to bond yields and risk and let's talk about oil. Do you get meaningfully more nervous if it's a boots on the ground situation, like the president is saying he has not ruled out at this
point? For the politics of it, Brian, or for the propriety of it? See, the propriety, I'm not privy to what they're privy to. Even when you say I'm supportive of it, I shouldn't word it that way. I'm supportive as far as what I know.
Well, I may have put those words in your mouth.
Yeah, but it's a fair way to summarize what I said because I'm going off of what Secretary Rubio is saying, and he's portraying a Reaganite view of American hemispheric presence, and I love hearing it. I love hearing it from the administration. As far as boots on the ground and so forth, I really do believe that it's a difficult thing for the president politically because I don't think there is a huge part of his base that feels that way about American responsibility in the world. I feel that way, but look, boots on the ground is likely not going to be necessary. My guess is that they are going to end up cutting a deal with the current regime. But again, I'm following the news like everybody else on this. They're privy to a lot more information.
Americans are expected to see bigger paychecks this year with the One Big Beautiful Bill Act now in effect. All right, so David, help explain for us what was just an extension from the 2017 tax cuts that thankfully did not expire and are being extended versus what is new? Because does that impact the way we feel? Does that impact real monetary stimulus into the economy?
No, it does not. And this is a very important thing to realize. Let's just pretend there's no such thing as withholdings. All there is the taxes you owe at the end of the year. There isn't a single change in the Big Beautiful Bill Act for individual tax rates and deductions. There's certain carve-outs if you happen to work off tips and some of the deduction for seniors on Social Security. That's very, very small stuff. Otherwise, it would have had a bigger impact to deficit. The major changes for Big Beautiful Bill, the stuff that I liked, are supply side, business growth on deductibility, bonus depreciation, capital expenditures, R&D expenditures. Individually, the standard deduction is larger. It's permanent now, but it's the same as it's been from 2017 through current. The individual tax rates, they're permanent now, but they would have gone way higher. That would have been a problem. but nothing changed. So what we're talking about when people refer to some cash flow difference is only withholdings, and that to me is different than any kind of actual sustainable tax cut.
From this vantage point, we can all talk like the tax cut, the 2017 tax cuts were always going to be there for us, right?
Yes.
But of course, if we ported ourselves back to back to 2024, there was a real question about whether those tax cuts would be extended.
To 24, not in 25. Those questions went away at about 1 a.m. on election night.
They did.
Okay.
But so here we enjoy the benefit of those rates staying low. And I agree. Yeah, this is a withholding change that people are going to enjoy. That's what you get in your paycheck week to week. It doesn't affect your overall, maybe, after-tax income. But I do think it's important to remember that we could be living in a world right now. We were very close to living in a world where your taxes would have gone up.
Well, now, why do you think that? You believe that the Democrats would have raised taxes on the lowest income brackets? And
They would have.
Why didn't Obama do it when he had it?
Well, one, I think
he had the House and the Senate.
Yeah, he did.
He didn't have the House. Excuse me. He didn't need it because it was going to automatically sunset. He didn't have the House.
I think the brand of Democrat you got right now in America.
Yeah, that may be true.
Would be very happy.
That may be true. But
they're talking about wealth taxes, David. They don't want to just tax your income. They want to tax your computer.
Well, the bottom.
Does the supply side economics that you're so excited about filter down into higher real wages by November? No. Why haven't we seen more of that already this year, the way we saw a big boost in Trump's first year in 1.0?
First of all, a move from the 35% corporate rate to 21%, which is what we saw in Trump 1.0, was one of the most meaningful tax bills ever, besides the Reagan tax cuts of the 80s. So it was just much more materially significant to a far greater number of people. But the reason why, in my opinion, is that it was off against the tariffs, that the impact of tariffs on small businesses was a pull while the push element was on the big, beautiful bill. I think it's a big story in 26. My political answer, which is not really what I'm good at talking about, is I don't think it will be a material factor in the midterms. But economically, I think it's a big question. I think people underestimate how meaningful the supply side benefits will be from big, beautiful bill, but it's up against an unknown. Is all of the data I see from the impact of tariffs for the companies that are actually paying it. So, Taylor, I have a question. How do we get high growing profits that we love as stock owners and bond yields staying low? Like the 10-year is measuring nominal GDP expectations. And if inflation is going to sit somewhere between 2 and 2.5%, which many would argue I'm being optimistic, but I'll grant that, it means we're talking about 1.5% real GDP growth if the 10-year is sitting around 4%. So either the 10-year goes higher because the economy is growing, which is good, or it stays lower because the economy is not growing, which you would think would eventually weigh on some of the optimistic outlook. That's where it's a little bit push-pull. When you're at 23 times earnings, you've already priced in the good valuations.
But do you think this is a market that believes in the Fed put? The Fed will come in.
I think every market believes in the Fed put. Anyone who doesn't believe in the Fed put has been asleep for decades.
Well, maybe.
Everyone wants to simplify investing. I think the simplest thing is follow earnings, right? Consistently, stock prices ultimately follow earnings. If they're growing quarter over quarter, that stock price is going to trend in that direction. But to your point, at 23 times earnings, those earnings better be growing very aggressively if you're going to buy into those valuations to bring that valuation down. So you look at sectors across the S&P 500, right? Valuations are overstretched except for energy and healthcare on an absolute and relative basis. So those are two pockets of opportunity, I think, in a market where analysts are calling for a 15 to 17% growth in potential earnings this year, maybe in 2027.
It's like you read my 2026 paper, but you haven't even read it. So he's reading my mind here. I agree 100%. The Fed put to me is an argument for defense. Like if something really bad happens, the Fed's going to come in and put something underneath it. That's a different argument than it's going to be growing earnings or it's going to be growing the economy. And I think Dagan's point is a good one, that the Fed should not be a part of our calculus here. here. Look, I think they are going to be cutting this year, but they can cut the short end. They cannot control. No Fed chairman has been able to control the long end. Not in Japan, not in Europe, and not through 4 Fed chairmen in a row here. Nominal GDP growth is what the 10-year is about. And we have a problem in our country growing right now. For all the optimism about that Q3 number, last year's real GDP growth was about 1.9%. We've never gotten back to pre-financial crisis real GDP growth. And so to me, that's the issue we're dealing with. Now, in the short term, can stocks continue going higher? Can there be a rotation that celebrates certain sectors more than others? That's more my view. But I do think people need to be cautious. I don't think they should be wildly optimistic that everything's going to continue growing.
Can I ask you a question? Can you make the case that if AI is structurally changing this economy, that portends higher valuations because productivity that can come for that, or just a big structural shift? Or is that all baloney too?
It is baloney, but it's fair baloney. First of all, the average has been about 16.5 times for 30 or 40 years. So 23 is a meaningful premium. However, the AI argument for higher productivity, higher margins, I'm always going to be skeptical when the answer for why we should be again really, really bullish at high valuation is this time it's different. Because I've never in my adult lifetime or through my study of history seen that work out well. When we predict that this time it's just structurally different. So I'm much more Buffett-like in my approach on this, that when people start saying something structurally is changing everything, now people are willing to pay 23 times earnings, it's all going to work out. That scares me because it indicates to me a complacency about risk.
The Midwest is kind of a diverse lot. It has places like North and South Dakota on the one hand. It also has places like Illinois and Minnesota on the other hand. So I don't know that everyone's viewing all those locations the same. But it is attractive, David.
It seems that most people in New York seem to think the Midwest is anything west of the Hudson River. Yeah. But no, you're right.
It's
very
an old
diverse.
New Yorker cartoon.
That is literally a New Yorker cartoon. That's right. I do not think that anyone has anything to fear about California and New York liberal politics going to Nashville and Dallas and Salt Lake City. It is the moderates and the conservatives that are moving to those places by and large. My company in the last 5 years has opened offices in Nashville, Phoenix, Dallas, Austin, Grand Rapids, Michigan, a lot of the middle part of the country, booming economies. The key here is not the wage growth. That's going well, but you need more jobs. Those big cities are getting new jobs. The smaller cities in the Midwest are not. That's the problem. So you need wage growth to follow an increase of jobs. If you get more jobs and more wages, the housing prices will go up. It would be news to people in Boise, Idaho, and Phoenix, Arizona, that they have cheap housing, because they do not.
Right.
And places where capital is fluid, people are fluid, people are mobile, and that's what we call a free country. That's why I don't fear China, because they don't have free capital flow, therefore they don't have free people flow. We do in America. It's a feature, not a bug.
There you go. And they do not have as good a hot dish as the Midwest.